Looking at section 3-1, we are going to be talking about a journal for the first time. So not using T accounts anymore. We are now be doing everything in a journal going forward. So we'll talk about the 4 parts of a journal entry and also talk about something called a source document. So a journal, and if you're looking at your reading guide, which can be found on PowerSchool, right here, chapter 3 reading guide, that will give you these notes that you can follow along and answer the questions as you watch the PowerPoint. So you can see at the top of your reading guide that we are going to be recording our entries into a journal, which you can see right there at the top of your reading guide. A journal is a form that you fill out to record transactions in chronological order. So we're not using T-charts anymore. We're going to be using a journal. When you're actually recording transactions in a journal, that is called journalizing. So the bullet point that says where can we find all of our account names and numbers, that's a chart of accounts. That's not going to go away. A journal is a more organized and a more permanent record of transactions. That's important as well. There are several different kinds of journals. So our journal has a sales credit and a cash special column, but every company could have that different. So there are several kinds of journals. Most business journalize transactions daily in order to stay up to date. So that is how a journal will work and what it looks like. And now we're going to talk a little bit more about the accuracy and all the good things about journalizing. It is just a much cleaner, more organized way of journalizing or doing a transaction than using T-charts. T-charts, that's how everyone learns accounting to start, to make sure you have a left side and a right side, or a debit and a credit. Now we need to put it in something that's a little bit easier for a manager or an owner to take a look at. So every time you put a transaction into the journal, that is called an entry, okay? And an entry always has to consist, so entries must include a debit and a credit. And transactions are journalized in order by date, always. So starting with January 1st, working your way through the year down the journal. So double entry accounting, that means that you have to have a debit and you have to have a credit. And it also means that you have to have at least 2 accounts. So double entry accounting, you have 2 accounts. And that was the first step when we did chapter 1 transactions with plus and minus. Chapter 2, when we learned about debits and credits the first time. The first thing you still have to do is find out what 2 accounts are affected. So that isn't changing. Double entry accounting just states that you have to have a debit and a credit. And once again, debits must always equal credits. Now we're going to be talking about source documents. Source documents are paper proof that a journal entry is originating from. So a source document on your reading guide, a source document proves that a transaction occurred. So we have to have some sort of proof before we do a transaction. Now in all of our examples, of course, we have very organized day by day the transactions we need to do. But in a real world setting, no one's going to provide you with that list of transactions. You're going to have to go through source documents in order to know what transactions you need to record. So the first thing that you need to know is that a source document proves that a transaction occurred. That's key. So our first source document is a check. So a check is used when cash is noted in a transaction, a check is being used. So we're not actually talking about cash dollar bills, okay? When it says paid cash for supplies, we actually wrote a check. Okay, that way we have a paper trail of the transaction, proof that the transaction occurred. On your reading guide, it says a check stub is used to keep tabs on the balance in a checking account. So over on the left side of this check, that is the check stub. So you record the information, you fill out the check, transfer the information over to the check stub up here at the top. because you're going to tear off this check and give it to Eastside Supplies. So what you're left with is the check stub, and that is our proof of the transaction. Our next source document is an invoice. So you maybe receive invoices when you get something shipped in the mail. There might be a packing slip inside the box that shows the quantity and the price of the items, what should be in the box. Now, the difference for our invoices is we are giving people or customers a certain amount of time to pay us. So you'll notice that on this invoice, Delgado Web Services giving Main Street Services 30 days in order to pay that $500. So a sales invoice, when a sale is made on account, the customer gets their services, but nothing is paid yet. That's a sale on account. And the source document for when this occurs is a sales invoice. Our next source document is a receipt. Receipts are used when cash is received from the owner. So you'll see here on this receipt that the money was received from Michael Delgado. He made an investment in the company, and we want to record where that $2,000 came from. So we'll create a receipt. Our next source document is a memorandum. A memo is used when more explanation is needed or when a signature is needed for a transaction. So you'll notice here that we have a description of the transaction as well as signed by our owner, Michael Delgado. Lastly, here we have a calculator tape. So if you think of all the registers at Hy-Vee or Fairway, all day long they're bringing in cash when they make a sale. Well, if an accountant was responsible for recording a transaction, every time that happened, there is no way they could stay up. So instead, cash is put into a cash register or a drawer or a cash bag or a safe, and at the end of the day, someone uses a calculator that prints paper, so it's kind of an old school calculator, but they're awesome, and it prints out all the numbers that you added up. So at the end of the day, someone is adding up all the money in the cash register, and the total is what is recorded. So this way, only one journal entry is made a day for cash received at the time of sale. So now we're going to be talking about preparing journal entries, what it actually looks like. Well, sometimes a journal is called a book of original entry, and that's because this is where transactions first originate. This is a permanent record. So if you were doing this using paper and pencil, you would need to use ink, so it'd be permanent, or an accounting system that backs up entries. So our MindTap accounting system that backs up our entries, it saves it, which is really nice. So it's permanent. And if you were to be using paper and writing the transactions, instead of signifying 0 cents as 0.00, we need to put a dash. Okay, it just kind of cleans up our journal a little bit. So fill out these 4 steps on your reading guide. The steps to journalize. We're always going to have these 4 things every time we journalize. Date, 1 debit, 1 credit, and a source document. Those 4 things every time you do a journal entry. So here is our first journal entry. Notice that these transactions and scenarios are no different than what we've done in Chapter 1 and Chapter 2. So you can see here that we have that T-chart. That's exactly what we would have done in Chapter 2. We know we need to have a left side and a right side. So we debited cash on the left, credited capital on the right. A debit and a credit. Now we need to take that information from the T-chart and put it into a journal. So step 1, we have the date. Step 2, we have our debit. Say straight from cash in that T-chart. But we have one of our special columns, so we get to use the special cash column to write $2,000 debit. And we record our credit. Anything that is in the account title column is labeling or describing the number that's in the general columns. So Michael Delgado Capital is being credited for $2,000. And finally, we have a source document for every transaction. So receipt number 1, if someone wanted to see the original source of this transaction, they would look for receipt number 1. We're going to do the same thing for paid cash for supplies. So in Chapter 2, we would have debited supplies to increase our supplies by $165, and we would have credited cash because we paid cash or decreased cash. So now we're putting it in a journal. Step 1, we put the date. Step 2, our debit to supplies. So anything in the account title column is labeling what's in the general column. So on your reading guide, if you want to put an arrow from account title to general column to show that those two go together, you could do that. Finally, we have our credit. So cash, we never have to write cash because it has a special column, cash credit. And then finally, our source document. So this was check number 1, our first check that we wrote. So the source document for this transaction is a check. So that is section 3-1. If you have any questions, please let me know. Otherwise, you'll move on to the 3-1 work together.